Hello guys, welcome to this YouTube channel. In this video, we're going to be looking at liquidity inducement theory, the very backbone of smart money concept trading methodology. You must know that skipping any part of this video will make it intractable for you to comprehend this key secret and backbone of the smart money concept trading methodology I'm about to share with you guys. So you will do yourself well by not skipping any part of this video, else the learning process becomes ineffective. What really is liquidity? Liquidity simply means money. Liquidity is the fuel that moves the financial trading markets. Without liquidity, there wouldn't be volatility in the markets. It is actually the zone of retail stock orders which the institutions hunt and then move the market in institutional direction. There are basically two types of liquidity: the internal range liquidity and then the external range liquidity. When we head to the chart, I will explain the internal range liquidity and then the external range liquidity. And you must know that these types of liquidity further forms the chart patterns that act as liquidities in which the institutions seek to rate before creating significant moves in the markets. What now is the difference between inducement and liquidity? Basically, there is no difference between inducement and liquidity. Inducement is actually liquidity. Inducement is the first pullback before or after a break of structure that should be rated by a corrective move to validate a major swing point. It is actually a series of created inducement that leads to what we now call a trendline liquidity, which we are going to see in the chart. Inducement itself is liquidity. And one of the key things you must note is that you sell above the inducement and you buy below the inducements. Now, you can see from the charts, we have a market direction which is actually bearish. The higher time frame bias is actually bearish because you can see we have our lower high, our lower low, our lower high, and then our lower low. So the swing point of the higher time frame is actually the external liquidity. You can see here is our high point, here is our low point, here is our high point. In this market structure, you can see we have a multiplex structure within the higher time frame structure. So you can see that the lower time frame structure forms the internal range liquidity, which is actually creating the buy side liquidity in this particular aspect. And then we have the sell side liquidity created in this particular aspect, because we have the markets as a bearish directional bias. And then you can see that this is the impulsive move. Within the impulsive move in the higher time frame, we're going to be having the lower time frame market structure being formed because price is actually fragile. You would see structure in higher time frame, and also in the lower time frame, you'll find the market printing structures. So you can see now price move to the upside, broke the last swing point, and then we start having market pushing to the upside within the higher time frame retracement leg, giving us a bullish market condition in a lower time frame. And then the swing low we see here act as our sell side liquidity. So you can see here we have the external range liquidity. From this range to this range is our external range liquidity. From this range to this range is our external range liquidity. And within the external range liquidity, we have the internal range liquidity. So this is how you look at what liquidity: external and then internal range liquidities. So let's look at the chart for further more examples on how to apply the concept of liquidity and inducement in our trading. Earlier, I said that our types of liquidity further form what we call chart patterns. And these chart patterns act as liquidity in which the institutions seek to actually read before creating significant move in the markets. So you would know that the price action trading methodology, we have what we call chart patterns: the double top, the triple top, the double bottom, the triple bottom. We have the head and shoulder pattern. We have a lot of chart patterns: the wedge, the channels, the triangles, the flags. All these are internal range liquidities that the institutions will seek to purge before moving price in their ideal institutional direction. Now you can see here we have what we call our double top. The retail traders would actually want to put a sell order at this zone, expecting the price to fall to the downside, because they believe this is actually a strong resistance zone. But what the institutions would actually do is to rate all the stop losses resting here before actually pushing the markets in the lower direction. So I actually stated earlier that liquidity simply means money. So money is actually resting here. This is a zone of retail stock orders because the retail traders will believe this is actually a strong resistance level where price should come top the zone and then fall to the downside. But then you would see what the institutions would do is to actually push price to the upside and then rate this equal highs before pushing price to the downside. You can see in the case of a bullish market scenario where the market is coming from the downside and then you have the double bottom, the institutions would come push price to the downside to rate the double bottom because retail traders are actually looking to buy from this support zone. So their stop loss is actually resting below the double bottom. And then you would see that the institutions will push price to the downside. And then you would see they would rate all the stop losses resting here and then push price to the upside. Now you can see in the case of what we now call our triple top, it's actually liquidity resting here. The institutions will purge this liquidity, rate all stop losses resting here, and then push markets to the downside. The same thing happened to the triple bottom, where institutions would know that the retail traders have stacked their orders here because the retail traders will believe this is a strong support. So as you can see, the first return to retest the support zone, price push to the upside, the second return to retest the support zone. So the retail traders will regard this zone as a strong support zone, expecting price to come tap the zone and push to the upside. But what the institutions would do is to rate all stop losses resting here and then push price in the intended direction. So you can also see in this case here, we have market coming to the downside. We have push to the upside, push to the downside. Price did not move to the downside to break this low points. Price went back to the upside, created equal highs here, and then we have equal lows here. And then you can see that this equal high is actually a region of stacked retail orders. So retail traders will be looking at this zone as a strong support zone where price should come tap and then drop to the downside. But we know that the market condition is actually pushing to the downside. The retail traders would also consider this as a strong support, expecting price to come to the support zone and push possibly to the upside. But you would see the institution will rate this equal lows, which act as liquidity, and then price would push to the upside, rate also the equal highs acting as liquidity, and then price would push to the downside. You can also see, let's check for the example. I stated something earlier. I said that series of created inducement is what leads towards a trend line liquidity. Now you would see that when price pushed to the upside, price came down, price pushed to the upside, rated this high points. You can see that what we should be expecting is that this high point should come to the downside and rate this low points, and then we have a valid higher high here. But price came to the downside without rating this inducement resting here because the structure formed before the break of a swing point is actually our inducement. So the inducement transferred from this low to this low here. And then you can see price went further to the upside. And then we have this return without coming to rate this low points. In case you do not understand how to mark out this inducement, there is already a video in the YouTube channel how to identify ideal institutional order flow and also how to identify ideal institutional market structure. You can go watch those videos, especially how to identify ideal institutional market structure. You get to understand how to map out inducements. So you would see that now price came to the downside without rating this inducement to give us a valid higher high here. And then price pushed further to the upside. Now you can see we have trend line liquidity resting here. So you see price would come, rate the trend line liquidity, tapped into an ideal POI here, tap into an ideal point of interest, and then you see price will push to the upside. Because this is acting as a trend line liquidity because we do not have this higher high returning to raid this low point, neither this higher high coming to raid these low points. We have pushed to the upside that raided this high, but we do not have a return that grabbed liquidity before pushing to the upside. So you can also see in this market condition here, this is what we refer to as the inducement. You would see price drop to the downside. You see we have this return and then price push to the upside. I said something that the market moved to grab liquidity and then moves to fill inefficiency. So you would see that now price broke structure here, and then we have the inducement here. But this lower low to be valid, we want to see a return that would rate the inducement, and then we see price fall to the downside. So this is a valid low point because price pushed to the upside and then rated the inducements. And then you see we have fall to the downside. And then we have now also a break of structure here. Now we would see that what validates this as a lower low. This is a valid lower low because we have the push to the upside that rated this inducement. And then we have fall to the downside. So this is how you look at what inducements. The pullback before the break of structure or the pullback after a break of structure. Because we understand that inducement is actually transferable from the previous videos. So you would see that now price rated this low point, broke structure here, price return, took out the inducement, and then we see what fall to the downside. I will still show you guys a furthermore example before we head to the chart. Now, let's look at this chart example here. We have price fall to the downside. We have our low point, price return, printed the high points. Now you would see price came to the downside. We have this pullback and then price fell to the downside, and then we see the words break of structure. When price broke structure here, we have this movement here that created this equal highs. No transfer of inducement to this low because this low did not sponsor the move to the downside to rate this low points. So we do not have a transfer of inducement here. This is what I mean by we not having a transfer of inducement there. When we have price coming to the downside, and then we have this return, price came to the downside, created this inducement, price fell, broke structure here, and then we have this return, and then we have this fall. Now, this is our inducement. But the fact that we have the pullback and then price return and then broke this low, this becomes our new inducement. The inducement transfer to this particular point here. But we do not have that occurrence here. What we'd see is price drop to the downside, the pullback created our inducement, price pushed to the downside, broke structure here. You can see price return, but then we do not have a push to the downside to rate this low. So this still remains our inducement. And you can see now price created what equal highs here. So you would see that now price went to the upside, rated the equal highs, and you can see now price took out our inducement. This validates this as a lower point, as our new what lower low, because price came to the downside and then this lower low sponsored the move to the upside that grabbed this liquidity and also took out the inducement. And then we have the fall to the downside here. Price broke this ideal lower low because this lower low sponsored the move that rated the inducements. And then you see we have this return and then price pushed to the downside. This is not a break of structure. This is not a lower low because price did not move to the upside. There is no inducement rated here. So you would see that this return created what we now call the inducements, and then price fell to the downside. Now, this becomes our ideal lower low because price sponsored the move to the upside that now rated the inducements. So this is not a lower low point. This is our lower low point. And then you would see that what price fell to the downside, and then we have what a break of structure here. Now you would see that now price created a trend line here. You can see our market has been falling what to the downside. So we have our trend line here. We're having a bearish market condition here. So you can see price push to the upside, and then we have a break of what market's structure here that led to a what change in market character, because you would see that price push to the upside here created this lower high points, and then price dropped to the downside. Now price pushed to the upside and then raided the lower high points. So we have what a change in market what's character, and then we also have the break of what's the trend line. So what the retail traders will be expecting is to see the break of this trend line and then a retest of the trend line and then price push to the upside. What you would see here is price broke the trend line. We have the return and then price push to the upside. This is our inducement resting at this low point, because when price led to the change in market character, this is the first pullback that created this swing low. So we are expecting when price push further to the upside, we want to see the high point return to rate the inducements to validate this high point. But then we now see markets forming this channel here. So this channel acts as liquidity. But what the retail traders would be expecting is price broke the major trend line, retested the major trend line, and then you would see that price is creating this bullish market condition. So what the retail traders will be anticipating is they want to see the return of price to retest this trend line and then push to the upside. But you would see that this is just acting as liquidity, because we do not have a purge, a raid of this low to validate any high points created yet. And then you would see that now price created this high point. Then you would see that now price return to a sponsorship candle, resting here, and then price mitigated the candle, and then would see what push to the upside. All these are acting as liquidity because we have the push to the upside. This is the first pullback, and then price was just creating this channel here, and then price went up, raided the channel, took out this high. So what we would be expecting is for price to raid these liquidities resting here as the trend line liquidities, because this is our region of inducements created, meaning all these moves here are our inducement move. They serve as our inducement, which also serve as the liquidity. And then you see price came to the downside, purged the trend line liquidity, tapped into an ideal sponsorship candle, and then price pushed to the upside. So this is how you look out for all this liquidity and then inducements. Let me show you guys another chart example before we head to the real-time chart to actually test out this things. Now, what can you see from this chart example here? You would see that we have price push to the upside, we have this return, and then price push to the upside. Meaning this region here, this low is actually our created inducement. But when price pushed to the upside, this high point did not return to the downside to rate this inducement for pushing to the upside. So you would see that now price return created another swing low and went further to the upside and broke this point. This becomes our inducement. This is now a valid higher high because you see price return to the downside and raided the inducement. When price raided the inducement, which is also liquidity, you would see that now we have price ranging in this particular zone here. And then you can see we have relatively equal highs, relatively equal lows. You would see price purge the low point because retail traders will believe this is a support level, a strong support level that should hold price, and then price should push to the upside. But what the institutions would do is to actually raid all stop losses resting here and then push to the upside also and raid all stop losses resting here, because the retail traders will believe that when there is a breakout here, then price should possibly return, retest the resistance and fall to the downside. But you see that price purged both equal highs and equal lows. And we are also in a bullish market condition. Now you would see that price also created another equal lows here. So where is an ideal point of interest to actually mark out is actually the sponsorship candle resting here, because you already have the inducement here, and then you have all these liquidities resting here. So you would see price also created equal lows, and then you can see price return to the downside to mitigate an ideal sponsorship candle resting here, and then price push to the upside. And then this is where we have our break of structure. This is not a break of structure, because this low is actually our inducement created after the break of this high point. So this is our higher high because this higher high returned and took out the inducements. This low sponsored the move that broke structure. This high sponsored the move to the downside that took out this liquidity, this inducement. Price took out external liquidity, and then price created a new higher high, and then this higher high took out internal range liquidity. So this is how you look at what liquidity and what inducements. You can see also in this chart example, we also have what we call the engineered liquidity. The engineered liquidity is actually the first inducement created. And then when there is a transfer of that inducement to another inducement, to another newly created inducement, the previous inducement becomes an engineered liquidity when it is close to actually an ideal point of interest. So you can see here that what price fell to the downside, we have this return, price came to the downside, we have this return that raided this high, price fell, broke structure here. This is what a higher high. And then price dropped to the downside because this higher high took out liquidity here. And then we have the return to the downside, price pushed to the upside. We have our what inducement created here after the break of structure. So we want to see that what this low would sponsor the move to the upside to mitigate this point of interest and raid the what inducement. But this point did not move price to the upside to what raid the inducement. Then we have price fell to the downside. So you would now see that the inducement here was transferred now to this point. And then this becomes our engineered liquidity. And then this becomes our newly formed inducement. And then you would see that what this low point sponsored the move to the upside that raided the inducement. And then we have this return. Price did not move to the downside to break the low. Price went to the upside, return went to the upside. Now you would see that what price raided this inducement mitigated any form of sponsorship can do resting here. It could be fair value gap or order block. So where is the zone left unmitigated? It is actually this zone resting here because you have this movement to the upside that took out liquidity. So this is an ideal institutional point of interest to mark out. And then you will see that what price returned into that zone, and then we have what the fall to the downside. So now we're going to head to the charts to look at real-time chart example on how to apply these principles of liquidity and inducement in our trading. So in this market condition, we can see that the market was actually bearish, but now the market has turned what's bullish. And then now we would see that what price have tapped into a POI zone here, because you can see price pushed to the upside. We have the break of structure resting here. So we have the break of structure here. And then we have price inducements here because you can see this is the highest candle here. And then price returned to the downside and raided the low of that candle. You can see price raided the low of that candle. This candle raided the low of this candle. So we have our inducement resting here. Price pushed to the upside. We have return, but this high points did not return to the downside to raid the inducements. So the inducement was not transferred from this point to this particular point. So this becomes our engineered liquidity resting here. So we have our engineered liquidity resting here. And then after our engineered liquidity, price created the inducement here because the inducement here was transferred to this low point. So this is our engineered liquidity, and then this becomes our what inducement zone here. Let's mark it out. Then we see price further push to the upside. We have pullback here because this is the highest candle, and then this is a pullback. Inducement all transferred. We have a lot of inducement transfer here, but then price return into this order block here, resting here because you have the order block and then you have the fair value gap. So we want to see what would happen to price, meaning price is bullish. So we are actually aiming for this high if we want to take entry. So we want to see how to identify our liquidities and then also our inducements, which is actually also what liquidity. So you would see price have tapped into the order block zone, our POI zone. So we want to see now that once price break this high point, we have our change in what market character because price is within our what POI zone. Now we want to play price to see if price sweeps this low, then we have our change in market character, and then we can begin to look out for our what buy entries to the upside. So let's play price to see what price would do. So price is still pushing to the upside. So I think we now have our change in market character here. So let's mark out our change in market character. Price swept this high points here. So we have our change in market character. So after price swept our high points here, give us a change in market character, we want to look out for our inducement before the break of that structure. So you would see that now price created this sponsorship candle, this order block, because we have the sweep of this low. In case you do not understand how to mark out ideal institutional order block, there's actually a video in the YouTube channel that actually teaches on how to identify ideal institutional order block. And hey guys, please guys, if you're gaining value from what you're learning right now, please kindly click on the like button and also subscribe to this YouTube channel and also share our videos. So let's head back to the chart. So you can see now, this is now the order block created here. Let's mark out the order block here. This is the order block created. So this is our order block. Now you can see price push to the upside. All this movement is within this bullish candle. There is no sweep of the high, neither the sweep of the low. But I think we can see that this doji candle swept the high of the bullish candle. So we have this as our candle of reference, and then we see price pull back and then raided the low points of this candle. So this is now our inducement because we have the push to the upside, the pullback, and then the move that took out the high points that gave us a change in market character. So this is our inducement. So if we want to take entry, then we'd want to put our buy limits here and see if price would actually push to the upside. So let's see what happens. Now price did not return into our point of interest. Rather, price pushed further and then raided this high. So we have a transfer of inducement from this point to this point. So this becomes our new inducement. So we want to see price return to raid this inducement, and then we have a push to the upside. So this becomes our new point of interest since we have a newly formed inducement. So we have this zone as our newly formed zone. So this becomes our point of interest because we can see this candle raided the low of this candle and then sponsored the move that took out this high point, which is one of the characteristics of an ideal institutional order block. So let's see what price would do. So price is still playing out. Do we have an inducement here? No, we do not have an inducement because this move did not sweep this high points. So still, this remains our inducement. And then we can see that now price rated our inducement. Don't forget, we also have our fair value gap resting here from this week low to this week high. So let's mark out the fair value gap resting here. So this is our fair value gap. So we can take entry at 50% of the fair value gap, or we can take entry at the week of this doji candle. So let's take our entry at 50% of the fair value gap. So we're going to take our entry from the fair value gap. I will put our stop loss slightly below this candle's wick. So don't forget, we are aiming for the high point above. So we want to see price push to this upside. So let's see what happens to price. Okay. Wow. You can see price did not trigger us. Let's see if price is going to drop to activate our order, because price have not yet swept this high. So price is moving within a range here. Let's see. You can see price did not activate our order here. So let's see what price is doing. Price have not yet swept the high point because this is our higher high. Because our higher high took out the inducements. No. Price is still within a range. Now, price finally broke the high points. So we have a break of what structure here. So we have our what break of structure. So what we are now going to be looking for is also to look out for the inducement before the break of the structure. Now you can see here price move to the upside, return, move to the upside, return, move to the upside, return. Price was just ranging. And then we can see price gave us relatively equal highs here. Let's mark that out. This is actually a liquidity pool here. So we have liquidity resting here. Price rated the liquidity. Now you can see price first return, and then we have price rated this low here. So price rated this low points. Now this candle rated this low point, meaning this is our sponsorship candle. This is our order block. So let's mark that zone as our what order block. So we have our order block here. So we have our order block here. We now have price imbalance here. You can see price return into the imbalance and then push to the upside. We now have our what break of structure. So we see price push to the downside, created this high point. We have our pullback here. This candle rated the low of this candle before the push to the upside that was broke structure. Let's mark out that candle. So we have a sweep of liquidity here. So price swept this liquidity here. So meaning this low is our inducement, because what we are actually going to see is that price moved to the upside and then we have the pullback. So this is now our inducement. Our inducement was created before the break of this high point. So we want to see price return, break the inducement, return into a sponsorship candle here before pushing to the upside. What we are going to ask ourselves is, do we still have any ideal order block resting here? No, we do not have any other ideal order block resting here, because you can see price came into this, fill up this inefficiency, price pushed to the upside. We do not have any other block resting here, because you can see this candle swept the low of this candle. We have this as our order block, but these also have been mitigated. So price pushed to the upside, and then we have this candle here. This candle created the high, and then this candle swept the low of this what candle. So we do not have really any valid sponsorship candle to consider here. So let's play price to see what happens. Now you can now see that now price pushed to the upside, return, price pushed to the upside, meaning our inducement switch from this candle to this what particular candle here. So this is now our inducements. We have our transfer of inducement from this low towards this particular low. So we want to see if price will rate this low, tap into any sponsorship candle here, but we still do not have any valid sponsorship candle resting here. So let's play price against the scene. Now you can see that now in this particular zone here, what you would see is price return gave us another inducement. Our inducement is now transferred from this low to this low here. Because we do not have price return rate of this inducement, price did not rate this inducement. Price created a new structure, return, but this move did not push to the upside to rate this high. So price return, this is now our newly formed inducement, because this move to the downside did not rate this low point. So you would see that now price push further to the upside. Now we have a pullback here. You can see this is the highest candle, but that this candle rated the low of this candle and then pushed to the upside. So the inducement transfers again from this low point here to this particular what low point here, because you can see that this low point did not sponsor the move to rate this one, because we do not have any sponsorship candle, any ideal order block left here for price to come mitigate. And then you would see that now this also pushed to the upside, rated this high. Now we have a pullback that rated this candle's low points. So transfer of inducement takes place from this low to this what low point, meaning this is now our newly formed what inducement. We should not forget that this move to the downside did not trigger our what order for us to be in this trade, meaning we are not yet in this particular trade. So we want to see what we can do now. So you see below the inducement, we have a sponsorship candle, because you can see price rated this low point and then sponsored the move that rated this what high point. And then we have what our what inducement here. And don't forget, we have not yet created what a new higher high. This is our higher high. This is our what higher low here. So we've not yet created a valid higher high points, because you can see all of these movements have not taken any inducement towards the downside. So now this is now our newly created inducement. So meaning this is now our new point of interest. This particular order block resting here. Also, to the order block, you can see that now we have what the fair value gap from the week high to this what week low. We have our fair value gap resting here. So we want to see if we can take entry here. You can put your entry at the 50% of the fair value gap or at the week of the order block. So let's put our entry at the 50% of the fair value gap in order not to miss the trade. So now we can now project our take profits to the high points here. So we want to now see where we'll set our stop loss. Our stop loss will be below our what order block what zone. So let's set our stop loss below the order block zone. We can use this low point or set it below this low point. So let's use this low point here. So let's play price and see what happens. So price is still moving. Now we can see that what price moved to the upside here. Price moved to the upside here. Price did not return into our what entry zone. So our inducements move from this low point to this what low point, because we can see this is the highest candle. Price pulled back, took out the low point, and then we see price push to the upside and then took out what this high points. So this is now our what newly what formed what inducement. This is now our engineered what liquidity. So let's see what price would do. So price is still pulling to the upside, coming downwards. Price is still pulling downwards. Price did not break this high point, so we do not have a newly formed inducement. This is still our what inducement here. So let's see what happens. So if this move here had pushed price to the upside, then this would have been our what newly formed what inducement. But this is still what our what inducements. So let's see what price would do. Still yet. Okay, price is dropping to the downside. Okay, now you would see that since our inducement shift from this particular candle low to this low point, now you would see price came to this sponsorship candle here, this order block, because we have the sweep of this candle's liquidity, and then we have what fair value gap here. This candle swept this low, and then we have what our fair value gap resting here. So you can see price came tapped into it. So let's see if price is going to push to the upside. Price did not return to our entry. So let's see what price is still doing. Okay. Now you can see price pushed to the upside, but this price did not move to the upside to come rate this high points. So there's still a possibility of price dropping down to our what point of interest. Okay. Now price dropped to our what point of interest. We're now in this trade. So let's see what happens. Let's see what price would do. Now you can see price is pushing to the upside. Okay. This is still our newly created high. Price have not rated the high. So you can see that now price took out the inducements by the move coming to the downside. Price took out the inducements. So we have what's a newly formed higher high here. So we have this as a higher high. We have our higher low here. Now we have our newly formed higher high here. So let's see what price is set to do. Okay, price is still returning. Wow. Price returned back to our entry. All right, let me pause this video and come back and we'll see what price have actually done. So we can now see price pull to the upside without reading the high points, which is still a valid move. Now you can see that now price came to the downside into the zone, and then we have what pushed to the upside. And then you can see that now we have what's the break of structure here. Now you can see we're looking at the inducements. Now look at something here. Retail traders will regard this as a trend line. You can see price give us something like a trend line here. So retail traders want to see price return, retest the trend line, and then fall to the downside. But you can see our directional bias is actually bullish. So this is actually a trend line liquidity. To entice the retail traders to place their order here, thinking the price will fall to the downside. But you can see price raided all the possible entries here and the stop losses placed here by the retail traders. Because you can see when this candle came, tapped the trend line, gave a little rejection to the downside, but you can see an impulsive move went on to the upside. So also within this zone here, you can see price was forming a little form of trend line liquidity here. Retail traders will look at this in this form, that this is actually a trend line, expecting that this return should come to this point, and then we see push to the upside. But what can you see is that price return into a sponsorship candle, because this is the candle that sponsored the movement we are seeing here, because our directional bias is also bullish. And then you can see we have the created inducements here. So price return, raided the inducement, raided the first inducement resting here. This becomes our engineered liquidity, and then we see price push to the upside. Now we have our break of structure here. So we want to look out for our inducements. Then we want to look out for the possible point of interest in which we want to now take another buy to the upside. You can see that now price came, and then price actually tapped our take profit zone. So this high is still protected. We want to see price break this high point to continue the bullish move. You can see that this movement is still within this retracement. So let's check out our inducement and then our possible point of interest below our inducements. So our price tapped into our POI zone, and then we can see this return. Now what you would notice here is that price dropped, gave us this pullback, and then went back into our point of interest. Now this pullback is acting as an inducement, but in this case, since we are in a bullish market condition and price is within our POI zone, and then price sponsored this move and took out this point, this becomes a change in market character. Now we can look out for the inducement resting below before the change in market character, and then the sponsorship candle we can consider. Now you would see that we have price push to the upside here, return, push to the upside, return. This is our inducement resting here, because this is the pullback before the move to the upside that gave us a change in market character. So we want to see price come raid this inducement, but price went further to the upside, return, and then we see price pushed again, raided this high points. We have a transfer of inducement from this low to this particular low points. So meaning this is now our inducement, and then we have an ideal sponsorship candle here. This is our ideal order block resting here. So we would want to see price return to rate this inducement and then push price to the upside. So price did that, price return into this order block, and then we see price push to the upside. Even though we can see price push to the downside, possibly rate our stop loss, and then price push further to the upside. Now look at what retail traders would do. Retail traders would also consider this as a trend line. Now, expecting that price came, tapped here, push. So they want to see tap to this zone and then push to this upside. But this is inducement. Price would need to rate the inducement. And price did that. Price came, rated the inducement, and then you see we have push to the upside. Now, before the break of our structure points, we have our inducement resting here. We have our inducement resting here because you can see price push to the upside. This is the highest candle. Price return rated the low of that candle. So this is now our inducement points resting here. So we have our inducement here. So we want to look out for our POI zone that we're expecting to see price return, and then we see push to the upside to validate this as a higher point. So we now see that this would be our order block to mark out this zone here. I won't really stress on how to mark out order blocks. There's already a video in the YouTube channel for that. So we can see that now we have the fair value gap here. We have a lot of pool of liquidities here. So we want to see price return to this zone and then push price to the upside. So let's play price and see what happens if we're going to have a return that will rate our liquidity here. So our inducement is still resting without being rated yet. So price is still moving within a range there. Okay, our inducement is still there. Let's see what price is doing. Now you can see, let's check this movement here. Price push to the upside. Now you can see, we have this pullback before the move that took out this high point. So we have our new inducements here. So we have our inducement transferred from this point low to this low point here. So would not look out below our inducement. Do we have any sponsorship candle? Below our inducement, do we have any sponsorship candle? So we can see that we only have inefficiency resting here. So let's mark out the inefficiency. So this is the inefficiency resting here. So I won't really want to take entry here since it doesn't fit into the criteria for my ideal institutional order block. So let's play price and see. Okay. Now, you would see that price return, but this move did not sponsor the move to the upside to sweep this high points. So this is not our inducement. This is still our valid inducement. Rather, you would see price give us relatively equal high. Liquidity resting above. Yeah. So we have liquidity resting here. Let's play price and see. Okay. Price, I've not yet rated the inducement. Okay. Now we can see that now price rated this high points. So without rating our inducement, price took out this liquidity resting here. So we'll have to now look out for the inducement before the rate of this high points. So you would see that price return, price give us this high move. Yeah. This is the pullback because this return rated the low of this candle here. And then we have this push again to the upside. This becomes the highest candle that took out to this point. And then we have the pullback. So meaning our inducement is now this particular low point. So this is our newly formed inducements. So let's play price and see what price is still doing. Okay. Now, you would see that price purged our inducement. Price raided the inducement. So I said something earlier that the market will aim for liquidity and then aim towards field inefficiency. So you can see this inducement serves as liquidity, price return, raided the inducement, and you can see the push to the upside. So meaning this becomes our newly formed high points here, because this sponsored the move to the downside that raided this inducement. Let's see what price is set to do again. Price is still playing out. We want to see the rate of this high points. Because if you can remember, we do not have any valid reason to take entry here because we do not have any of our ideal sponsor candle here. So we had no reason to take entry here. Okay. Price is still making some movements here. Price is still moving. Okay. Now we have the break of this high points here. So now we have our break of structure here. So meaning, so we want to look out for the inducement before the break of structure. So you can see price move to the upside. This is not a pullback because this movement is still within this candle. Price push to the upside. We have pullback because there's a sweep of this low, which is the highest candle. Price push to the upside. We have this high candle, price return. Price return swept to the low of the candle. We have push to the upside. This is the highest candle. Yeah. Price return swept to the low. And then we have this push. So we have our inducement resting here. So this is our inducement here. So we have our inducement here. So below our inducement, do we have a sponsorship candle? Yes, this is our sponsorship candle. This is our order block. So we'll mark out our zone. This is the order block resting here. So we want to see price return into this order block and then push furtherwards to the upside. So we're going to put our entry. You see, we also have the fair value gap resting here. This weak low to the weak high. This is also our fair value gap. So we want to take our entry at the 50% of the fair value gap or the body of the last bearish candle. So let's place our long position here. Our stop loss below the low of the candle, and then we can take our profits to be 1:3. Since we do not have a reference high points by this side, except we want to switch to higher time frame. So let's play price and see what price would do. Okay, so you can see price triggered our entry, and then you can see we are moving to the upside. So you can see that price formed also relatively equal highs here. So once you see price purge it, yeah, price purged it. Now you can see price went to our profit area. So this is how you look out for the structure points. Now you can see here that retail traders will consider this as a trend line. This as a trend line. So retail traders will consider this as a trend line, expecting price to return, bounce on this, and then you see push to the upside. But all of these are just liquidities. All of these are liquidities. So you can also see price created this form of trend line, also liquidity here. You can see we also have this trend line liquidity resting here. Retail traders would expect that since price came to the downside, broke this trend line, You have this, so price should come, return to this and fall to the downside. But you see price pushed to the upside. Don't forget, you would always want to trade in accordance to the trend. So guys, like this video to help this video reach out to a lot of people out there, and to also encourage me in bringing more content your way to explain the smart money concept trading methodology to you all. So cheers guys, and God bless you.